Okay, so this week we'll be having a look at Besi Semiconductor Industries, which is a semiconductor business that is located in the Netherlands and it's being hosted on the Euronext of Amsterdam. Now, this is quite different from the more stable, usual companies that we did previously, and because Besi Semiconductors is a semiconductor industry which, and I quote here from their website, develops leading-edge assembly processes and equipment for lead frames, substrate, and wafer-level packaging applications in a wide range of end-user markets, including electronics, mobile internet, cloud server, computing, automotive, industrial, LED, and solar. Now, I'm going to be honest here and say that, honest to God, I have no idea exactly what the intricate details are of a semiconductor business. Um, there's a lot of things going on there that I do not understand, and therefore for me it's always a bit tricky to invest in these kind of companies because I'm not sure if they've got a technological edge on competitors or whether or not they may not exist a few years from now. I honestly God have no idea because I do not quite understand it. But that being said, I do understand their financials. So we'll be having a look at that now. And it's important here to know, though, that semiconductor industries, as the industries as a whole, is quite a cyclical business. And you can see that with Besi Semiconductors as well as with Intel or AMD or TSMC or NVIDIA. Um, they have years where they are performing way beyond any other stocks in the market, and their growth is seemingly unlimited. And then you've got years where they cannot reach their targets, and they're actually going down, down, down a lot in the stock market, especially when there's a recession or like a downturn happening, and semiconductor industries cannot get enough buyers for their products, which is what you see right now as well during the inflation time and recession time, where the semiconductor industries are being hit the hardest. Now, this is a cyclical nature of semiconductors, which makes it a bit more risky. But again, with more risk comes more reward. So let's have a look here at their overall financial data. So what we can see here that in 2012 they posted a revenue of 274 million. Now, first thing you might notice here is that these numbers are quite a bit smaller than what we used to with the previous companies because Besi is quite a relatively small company. So they hosted 274 million in 2012, going all the way up to 749 here in 2021, which is an annual growth rate of 11.8% when it comes to their revenue. Which is a nice, steady, double-digit growth. What we expect from a semiconductor company to have some growth in there. This is because we pay for that growth as well. Because um, I mean, it's a growth business. They need to innovate. It's a competitive business, and they have been growing quite steadily here with the revenue anyway for 12%. When it comes to earnings here, in the very first year of 2012, at least in our financial share sheet here, they posted earnings of 21 million. And they improved that all the way up to 335. 2021 was an absolute record year for them when it comes to their earnings. Um, and they were actually able to convert about half of their revenue into earnings, which is an absolutely great profit margin and exactly what we like to see. 36% year-over-year revenue earnings growth. Sorry, that is tremendous. That's amazing, and that is something that you can only see with highly technological companies, tech companies like the semiconductor businesses. But what you might also notice here is that even though this year, for example, they've increased it with 192%. The next year they've been decreasing it by 11%. And as well for 2017, where they've increased it by 150%, which is amazing. For the next year, they've been decreasing it by 16 and even 40% after that. So again, this is the cyclical nature of semiconductors. There's no stability here when it comes to constant earnings. And this was also a very scary year for Besi Semiconductors because the moment that a growth company starts growing, the entire projection that analysts have for the future is like going to tumble and crumble. Um, and that's also what you saw with Netflix, for example, just last year, which had a share price of about 600, I think, and it came down all the way to 200 something. And this is because for the first time in forever, Netflix started showing negative growth. They actually showed declining subscribers, and that means that the entire growth estimate that we have here, that we base our projections on, suddenly wasn't there anymore, and therefore the entire projections for the future came down, and the stock price came down with it. So that's always a scary thing with growth companies, the moment that they stop growing, which seemed like happened here in 2018, which is also reflected in the share price as well, for sure. But we'll get to that in a little bit. 36% is amazing earnings growth, and also like nice increasing margins, because their earnings are growing quite a bit faster than their revenue. Looking at debt here, we can notice that they actually have very little debt. If we look at 2021, they have a debt level of 301 million, but their earnings were 335, meaning with just 1 year of earnings, they can actually pay back their entire debt, which makes it a very safe stock for us to invest in. Looking at excess cash as well, if the earnings wasn't enough to cover the debt, the cash on hand will be, because they always have more cash on hand than they have debt. So this makes it a very safe and secure balance sheet. Looking at market cap, they have been steadily growing 42% year over year. Honest to God, I wish I knew that Besi Semiconductors was going to have a growth like they had in the past 10 years, because I would have jumped in right here 2012, because my goodness, this growth annual is amazing. On average, the stock market returns 10%. Besi has been doing 42%, which is kudos to them for maintaining a proper business and giving good value back to their shareholders. Enterprise value is the market cap to which you add the debt and subtract the cash. It's the total value of the business. Now, for Besi Semiconductors, this is actually mostly the market cap, because they always have enough cash on hand to balance out the debt. So their enterprise has been growing in line with market cap, surprisingly exactly in line here. Looking at the EV/EBITDA ratio, now these numbers are quite a bit higher than all the previous company that we've looked at, apart from Republic Services. But again, that was a US company, which was more oversaturated than the European market. But for a European company, these are quite high ratios. And this means that we pay a certain premium for a company like Besi, because we do expect them to grow considerably in the future. And this is not a crazy ratio to see actually for semiconductor companies. It's quite normal, and maybe even the low end again compared to the American market, but definitely a lot higher than we've seen previously. Their debt level, there's nothing much to say here. They basically have no debt, because they can pay it back whenever they want. So as an investor, that's very attractive, because there's no risk of bankruptcy whatsoever. Looking at the cash flow statement now, looking at the cash flow from operations, all the money that they make simply from making their chips and selling it to anyone who's willing to buy them. We can see here that they've been making 39 million in 2012 and raised it all the way to 277 in 2021. And maybe the more interesting thing is the column right next to it, the capital expenditure, because they have basically no capital expenditure, which is quite rare to see compared to all the previous companies that we've seen. But Besi is just like, they have one massive facility somewhere in the Netherlands, and in that facility they of course have to put a new coat of paint, maybe have to buy some new chairs, some infrastructure, some computers, maybe every now and again they have to build or replace some parts in their machines. But by and large, they keep on operating with the same equipment that they have available, and they are making very, very nice cash flow from that with very little investment. Now, of course, it has to be added, though, that they also have some R&D expenses, which is not included in the capital expenditure, which is also like a few millions. I think even in 2021, I think it was about 7 or 8 million of research and development, which is really not that much compared to the earnings, and is easily covered, but should be noted, I think, because of course it's not just capex when it comes to expenses that they have. They also need to make sure that they stay competitive for the future, and actually staying at the forefront of innovation and technology. Free cash flow, at the end of the day, 44 million in the start of 2012, ranging all the way to 295 10 years later, with an annual growth rate of 24%. Yeah, amazing growth, exactly in line with cash flow from operations. And because capex is basically, well, it's exactly zero according to this, because it's basically zero. all of the increase in cash flow from operations is flowing right back to the free cash flow, which is the cash flow that's meant for you and me as the investor or the stockholder, because Besi actually has a very aggressive dividend policy where they pay out 90% of all the free cash flow, all the earnings that they make, they pay out in dividend every single year. So that means that there's not that much left to actually buy back shares or invest into new facilities or invest into different technologies or more into R&D. No, they mostly just realize that they're operating a niche business, because I think they're doing hybrid bonding and they're one of the only ones in that field that actually do that. So I think they're happy sitting on their niche business, getting the money from that and not investing that much back into the future. Looking at their shares, it's been slowly increasing by about 1% year over year for the last 10 years. They've increased about 10 millions of their common shares into the market, which is mostly, in all fairness, because they never needed money to expand or buy back debt. So all the share dilution that you see here is stock-based compensation for their employees. Now, I do notice here that they actually bought back some shares in 2018. But this seems to be a rare occasion. Maybe it might happen in the future as well, to try and compensate for the stock-based compensation they give to their employees, but only time will tell when it comes to that. Free cash flow per share has been growing in line with the free cash flow, and because the shares have been diluted a little bit, of course, it's not growing quite as fast, but still a very nice number, 22% year over year, which is amazing growth for any company, and any company would love to have that number on their books for sure. Now, looking at the price again, like I just mentioned, I wish I bought Besi in 2012, because my goodness, it had a hell of a run in the 10 years to follow. On average, 44% share appreciation. And this does not even include the dividends that they've been paying out, because they also have to be paying out yearly dividends, like I mentioned, the 90%. So this is €3.47. I think they paid about €3.30 in dividends, which is not included in the share price. And that comes to now we come to the free cash flow yield. This is the percentage that they of free cash flow compared to the stock price. Now again, 2018 was a scary year, because they were actually showing reduced growth, which really scared investors and made the stock price plummet quite a bit. But what we can see here, that because the free cash flow yield was 12.5%, this means that 8 years of running the business like they did in 2018, 8 times €2.31, and you will be able to buy back a share for free, basically. So the return on investment here is 8 times, because of the 12.5% yield year over year. This is kind of what that means. So yeah, let's try to project this company into the future. And like I mentioned, this is a very difficult thing, right? Like, if I was able to accurately project a company like Besi Semiconductors into the future, I wouldn't be here making videos. I wouldn't be here investing. I wouldn't be here, I don't know, getting an education or working to make a living, because I'd be sitting on a Caribbean island somewhere drinking mojitos. Unfortunately, I'm not that good in predicting. If I was, honest to God, I wouldn't be here. So, but I'm going to give it a try anyway. Like I mentioned, Besi, it's a semiconductor industry, and it's very cyclical, which means some years are definitely better than others. But on average, their earnings have been growing like 36%. I think that's going to come down. Quite frankly, I think it's going to come down. And I already know, like, for the last few quarters in 2022, the numbers have been coming down already, and their order book is shrinking quite a bit. I think it's also important to notice here that the biggest buyer of Besi Semiconductors is actually China. About 1/3 of their revenue comes from Chinese customers. And with the entire chip war going on right now between the United States and China, sales to China might be a bit restricted in the future, which actually will hurt Besi quite a bit in their revenue. So even in the future, actually, I do expect the earnings to come down. But I know for 2022, their earnings are not as growing as fast as they have been doing historically. So I'm going to give them 10%, because, again, I want to be conservative. And if my conservative estimate beats the stock market, at that moment I'm interested in buying stock. So for the first year, I'm going to give them 10%, but afterwards, I'm going to give them the benefit of the doubt. I'm going to say, you know what, I do expect you to keep on growing your revenue because we're going to be needing chips in everything in the future, in our vacuum cleaners, in our fridges, in our microwaves. We're going to need them everywhere. So you know what, I think there's some room for growth there. I'm going to give you 25% for the upcoming 4 years after that, which I think is being very nice to them. Um, but for the 5 years after, I'm going to give them 15%. I'm going to say that their earnings growth is going to come down because, again, they do not invest as much into R&D and staying at the top of the innovation circle. So I think that might hurt them in the long term, and therefore I think their earnings are going to be coming down 5 years from now. So I'm going to give them 15% there. Multiple, I'm going to give them 13 times. Now, for the last 3 years, they have been quite a bit higher than that, actually. But on average, they've been about 14.3 times. This was mostly because COVID was quite a big factor here. I think the multiple already came down here because the stock is definitely not 75 euros anymore at the time of making this video. And I want to be conservative anyway, even though the historical average is 14 times. I want to make a conservative estimate. So I'm going to give them 13 times, and I think that's very fair for me to make my prediction. So this gives me an enterprise value of 23.5 billion, less the debt, add the cash. They basically cancel each other out. Gives me a market cap of about 24 billion. Divide that by the amount of shares outstanding, leaves me with a stock price of 281 euros and 12 cents. Okay, so now we move to the free cash flow model. With this, I'm going to give them like a similar thing. Free cash flow has been growing 22% year over year, which is quite a staggering high number, right? Again, for the next year, I know it's going to be a bit lower than that, so I'm going to give them 10% for the next year as well, and then I'm going to give them the benefit of the doubt. I'm going to say 15% for the few years after that, because I do expect chips to be very important in the future. But just like with the enterprise value model, for the 5 years after that, I'm going to give them a reduced rate, because they're not investing as much in R&D, and because I do think they might be losing their edge there a little bit. So I'm going to give them 10% growth, which is still double digit and still something that every company in the world will probably strive to have. But it's definitely a lot lower than they've been doing historically. Free cash flow yield, I'm going to give them 6%. Again, in the last few years, they have been a lot lower than this, which means that the stock price projection should be a lot higher. But I want to be conservative. I always want to be, so I'm going to give them 6%. Now, just to give you an indication of what this might look like, if I give them 4%, it will change by quite a bit, right? But again, conservative estimate, that's what we're here for, because it's still a cyclical and risky business, and I want to make sure that when I make an investment in a risky business like that, that I want to take the most conservative route that I can. So as of this moment, I can buy as many shares as I want for 65 euros a pop. I think earlier in the year it actually was around 40 something, which was I think an absolute steal back then. But right now it's in the middle between the high of about 88 euros and a low of 40, 47, something like that. It's currently at 65. So we've got the enterprise value model and we've got the free cash flow model, which are actually quite different from each other when it comes to valuation. And I'm not sure which one is going to be right, so I'm just going to cut them down the middle again and say on average, I think the stock price 10 years from now will be 230 euros and 17 cents, which give me an annual compounded growth rate of 13.5%. And this is a number that will beat the stock market because, like I always mention, on average, the stock market returns 10% a year. And even with some of the most conservative numbers I could give Besi Semiconductors, they still return on average 13.5 times, which pretty much beats the market. Now, I have to say as well, many of the big investment banks, they have been setting a price target for Besi of around 90 euros because I actually think that 65 is undervalued, which I actually think, based on my projection here as well, is actually quite fair. I think if I give them 90 euros, which should be their current price, at that point they return 10% on average, in line with market expectations. But the current share price is 65, so I'm just going to keep it at that. And just to actually give you an indication of what it means when a company starts growing, right? Why, let's see, the year 2018 here was such a scary year for investors because Besi stopped growing. So the moment that Besi here stops growing, and I'm not going to say they grow negatively, I'm just going to say they grow nothing at all. At that moment, the stock price prediction comes down from 225 to 92, right? The growth is a big part of the stock price projection in the future, and it's a big part of the premium that we pay for the EV/EBITDA ratio or the free cash flow ratio, because this is based on future projections. This is based on how much we think the stock is going to be making, how much this company is going to produce in free cash flow in the future. So this is why growth is so important for a company like this, and this is why, at least for me, it's quite scary to invest, because I have no idea where these numbers are going to be heading in the future. Okay, they might grow a lot more than this, they might grow a lot less than this. Now, if I'm just gonna give them the benefit of the doubt and say that they will grow in line with the, no, that's a bit too much, with the 35% that they've been doing historically, again, this will also give them an absolutely crazy valuation 10 years from now, 843, right? Crazy numbers. Will give me an average growth rate of well over 20%, and I think at that point it's only fair that we only look at this number and no longer at percentages, and no longer at this. Yeah, 843 gives us an annual growth rate of 30%, and that is only if they maintain the current earnings growth that they've been doing for the last 10 years. And if they do that, of course, we can also give them a higher multiple, because they have been growing consistently, which deserves a higher multiple, maybe even 18 times. My sheet can't even handle that number. 1166. Right. This is absolute best case scenario, I think, for Besi Semiconductors. And that's like the thing, the range of what can happen with a company like this is so massive that it's very difficult for me to project it. But I'm just going to say, I'm going to stick to my most conservative projection of the future. And I'm going to say that I think this 14% with the most conservative estimates I can give it, which is not in line with historic performances. This is definitely very conservative compared to that. They still very much outperform the market. So this is of course not investment advice, because all investments have risks, and especially semiconductor companies, they have some more risk than most companies do. But with more risk comes more reward, and I think Besi Semiconductors is definitely a company that could give you a very good reward for the risk that you take. Okay, so that was it for this week with Besi Semiconductor Industries. Thank you very much for watching. Don't forget to subscribe, like, and all that good stuff, and I'll see you in the next one. Cheerio!